Hi, we're looking at advanced auditing and assurance, and today I would want us to look at a question that covers three standards, three international accounting standards, or IFRSs. And this question is here. All right, so we're told here, you are an audit manager in Coram & Company, a firm of CPA in this case here. The audit of one of your client's clerk company for the year ended 31st May 2018 is nearly complete, and the auditor's report is due to be issued next week. Clerk company is unlisted, family-owned business which specializes in the service and repair of both commercial and privately owned motor vehicles. The company operates from 7 geographically distinct sites, each of which is considered a separate cash-generating unit, CGU, for impairment review purposes. The draft financial statements recognize profit before tax of 2.3 million. Of course, they're giving us these figures for purpose of what here, calculating materiality, and total assets of 22 million. The schedule of uncorrected misstatements included in Clerk Company's audit working papers and prepared by the audit supervisor is shown below. You are due to attend a meeting with the finance director of Clerk Company tomorrow, at which the uncorrected misstatements will be discussed. Ladies and gentlemen, remember, when you're doing audit clearance, which is the last topic in CPA, auditing and assurance paper, audit clearance, you must come up with a list of what year errors, uncorrected misstatements. You must come up with that. So you must have a list of all the errors, itemized nicely, and of course showing the totals, right? That is so important because at the end of the day, this is a schedule that should be presented to the management for discussions. If possible, depending on the materiality levels, errors have to be corrected by the directors. If they refuse to do that, there will be repercussions in terms of what year, in terms of the opinion that I will issue as an auditor. So now here we are looking at a case where we have uncorrected misstatements. So we have a schedule. So before we issue our opinion, it's important to sit down with these directors. We have a discussion because really it's not our wish to give a bad opinion. It's our wish that we have the business, in this case here, correcting its mistakes and continuing being in business. Remember, as an auditor, when I give a bad opinion, chances are that there will be what here? Repercussions. Ladies and gentlemen, listen and listen to me very well here. We are told this is the schedule here of uncorrected misstatements. You can see the ones in the profit and loss, not too many. 85 here, I can see an expense. And then we have statement of financial position. I can see various errors there. And then we have the aggregates, the totals there. So we start with the first one, which is lease of testing equipment. Lease of testing equipment. In the jurisdiction in which Clerk Company operates, all motor vehicles over 3 years old are required to undergo an annual test of vehicle safety and roadworthiness. The annual test requires specialist test equipment, which is inspected by government officials on a regular basis. Following inspection visits in May 2018, the government inspection report required a Clerk Company to replace the testing equipment at 3 of its sites. They replace. In order to comply with this requirement, Clerk Company has agreed to lease new testing equipment from a leasing company on 6-month leases. So the question is, according to IFRS 16, is this a short-term lease? Is it a short-term lease? Ladies and gentlemen, remember that IFRS 16 basically tells us to look at the leases that we have, right? And in all cases, ensure that all leases appear in our statement of financial position by debiting what we call the right of use of an asset, and then you credit lease liability. So the asset goes to the non-current asset section. The liability goes to, depending, of course, either on current liability or current liability section. Right, so that is what we need to do. But now remember, there is an exception to this, which may make an asset that has been leased to be expensed fully in the income statement, not to go to the balance sheet, not to go to the statement of financial, and those exceptions are 2. Number 1, if the leased item has a lease period, which is 12 months or less, 1 year or less. Like now, this is a 6 months leased asset. Now, number two is the concept of low value leased assets like computers, like movable fixtures and fittings like that. They belong to what we call low value. But now remember, even in this exception, there is still an exception. If, for example, you've been given an asset whose lease time is less than 12 months, but you're given an option to purchase less than 5 months, less than 12 months, but you're given an option to purchase at the end of the lease period. If you're given an option to purchase, then start treating that as your asset. That's what IFRS 16 tells us. Start treating that as your asset. It's very important for you to recognize that. It's very important for you to recognize that. Great. Now, ladies and gentlemen, here we are. We are told here that replace the testing equipment at 3 of its sites in order to comply with the requirement. Clark Company has agreed to lease new testing equipment from a leasing company on 6-month leases. Under the terms of the leases, the company has no option, which is very good, to purchase the equipment. Therefore, these are short-term leased item which should be expensed fully. The testing equipment was made available for use by Clark at each of the 3 sites on 31st May 2018. The client had capitalized leases with a total carrying amount of $625,000 at the 2 of the sites, but has elected to take advantage of IFRS 16 lease exemption not to capitalize short-term leases at the largest of the 3 sites. As a result, the present value of the lease payments of $475,000 relating to this site has not been recognized on the company's financial statements. So two things. This $475,000, this lease has been captured in the statement of financial position. So as regards to the total assets, the $475,000, is it material? What do we have here? So materiality of the leased assets. So leased assets. So materiality, this is $475,000 all over the total assets there, which are worth 22 million times 100. So what do we have here, somebody? If you take 475,000 divided by 22 million, if you take 475,000, so if you take 475,000 divided by 22 million, right, times 100, I'm getting 2.16%. Material, it's more than 1%. So this is material, so 2.1%. So this person has made quite a good analysis here. What he has said is that for this largest site, he has decided to treat the leased asset outside the balance sheet, right? He's decided in this case here to take advantage of the exception given in IFRS 16, that if an asset has got a lease period being less than 12 months or less, then ignore. But you see now there is one disadvantage. There is one thing that cannot really, in this case here, apply here. Why? Because you can't make a choice here. This same asset is in other 2 sites. Remember, in total, the same list asset, in terms, they bought 3 assets, same class, and they took these 3 assets to the 3 sites like that. So there is no way you will say that this asset on this site, let me ignore, let me use the exception rule of IFRS 16, and then the other sites, I don't. If you make a decision, ladies and gentlemen, it's an accounting policy. If you make a decision, in this case, that you want to take advantage of the exception rule of IFRS 16, then all the 3 assets must be exempted. So in this case, ladies and gentlemen, look at even the other 2 sites. The other 2 sites, they decided to include the 675,000 figure. Was it 675 or 625? Let's see. Was it 625 or 675? Let's see. So in this case here, we are told that 625 actually. we are told here, under the terms of the lease, the company has no option to purchase the equipment. The testing equipment was made available for use by a Clark company at each of the 3 sites on the 1st May 2018. The client has capitalized leases with a total amount of 625. Why did you capitalize in the first place? And yet, in this case here, we know that these leases are less than 12 months. These are 6 month leases, 6 months without an option of procuring. So the best thing that they would have done is to, in this case here, fail to capitalize. They should have not taken these leases to the balance sheet. They should have taken these amounts and expressed them in the income statement. So here he has made the first blunder by capitalizing this list amount, this list assets are the 2 sites. That's the first one. So first of all, 625 over 22 million. In terms of materiality, we have this wrong capitalization of 625 all over 22 million times 100. What do we have there, somebody? So if you take 625, so we have here 625. So we have here 625,000 divided by 22 million, which gives me times 100, which gives me 2.84%. So this is 2.84 what year percent. So again, material, because it is more than what year 1%. So, ladies and gentlemen, what are we seeing here? We are seeing one thing, that there are 2 errors actually arising out of this. The capitalization, they have capitalized wrongly. And the capitalization amount of 625,000 is material. So that means that if it's material, I have to request for what here a change has to be done. And if a change is not done, then I will issue a qualified opinion as regards to this uncorrected mistake. So let's look at the answer here. So the answer is quite an interesting one. So what do we have, ladies and gentlemen, here? In the answer, this is what they have told us really. They're telling us here, very interesting, leasing over testing equipment. Lease at the largest site is material to the statement of financial position at 2.2. I hope you're able to remember this 2.16, which is the same as 2.2% of total assets. Leases at other 2 sites are also material at 2.8%. We got 2.8%. I hope you're able to remember that figure, right? So 1 mark is given for computing those materiality figures correctly. General requirements of IFRS 16 to capitalize all leases on statement of financial position as right of use asset at present value of lease payments from commencement date, i.e. date asset is available for use. IFRS 16 exemption optional for short-term leases of less than 12 months with no purchase option. Hence, if client elects, no need to recognize the lease on statement of financial position. Note the P&L effect yet as commencement date at the end year. The most important in this case is that you've elected to take advantage of the exemption. So if that is the case, don't put whatever assets you have there, whatever lease contracts you have there, don't put them in the statement of financial position. Short-term lease exemption must be made by class of underlying asset. Hence, treatment across 3 sites must be consistent. To discuss exemption with the finance director at meetings, if elects not to take exemption across the 3 sites, assets and liabilities are materially understated. Hence, the proposed adjustment is corrected under a right of use asset, and this liability of 475,000 should be what year? Should be recognized. Listen here, that we shall discuss this exemption with the finance director at the meeting. If he elects not to take exemption across the 3 sites, but he wants to capitalize, remember, it is optional. So if he says he would want to capitalize, now there is that 1 site asset which was not capitalized, the one in this case here that is coming to 475,000. So it means automatically that the assets of this company are understated by that 475,000. At the same time, the liability. Remember this 475,000 when I want to take the financial statements, 2 things. I have to come under debit. what we call the right of what year use of the asset, right of use of the asset, and then you credit what year you credit here, the lease liability. So it means that by excluding that 475,000 from the statement of financial position, the liability is understated and the assets are understated by a material amount. Very important for us to appreciate that. So if they choose, in this case here, to take the statement, to take this week as a statement of financial position, then the two. So you're saying to discuss exemption with finance director at meeting, if he elects not to take an exemption across the three sides, assets and liability are materially understated. Hence, the proposed adjustment is correct. And a right of use of asset and lease liability of 475,000 should be recognized. So the error that they've given us here, the error that we have been able to identify, the error here is okay, and we have given them, in this case here, what they need to do, they need to come and take the 475,000, the debit lease assets, and then we have crediting the lease liability. So we'll request, if that is the case, we request that they make that change. Now listen and listen to me very well. We are told here very interestingly, ladies and gentlemen, that alternatively, if the client does not elect to take exemption across all the three sides, then assets and liabilities now are overstated. Remember those two sides whose liability was coming to 625. Yeah. So in this case here, should they make a decision that, hey, these are now short-term contracts, then they have to exclude those short-term contracts from the three sides, right? From the statement of financial policy. That means that currently the 625 then will be taken in as an error because they're capitalized. So now we need to recognize that. We need to recognize that. Great. Now, ladies and gentlemen, please listen here. What have they told us here? Impact on audit opinion. If client makes no adjustment, then the statement of financial position is materially misstated and the audit opinion should be qualified on the basis with an except for opinion. This is very important. Ladies and gentlemen, please let's look at the second case scenario. So the second case scenario, what do we have here? In this second case scenario, this is what we have. The concept of the lease claim, there's an error of 1.2 million, right? So you're told a legal claim. A customer of Clark Company successfully sued the company for negligence in April 2018 after suffering a personal injury at one of its sites. The court awarded the customer 1.2 million in damages, and these had not been paid as at 31st May 2018. So meaning that the 1.2 million is an outstanding liability. So meaning that their liabilities, if they don't include this 1.2 in their liabilities, it means that the liabilities are understated. The audit working papers include a copy of a verified letter dated 25th May 2018 from an insurance company confirming that the claim is fully covered under Clark Company's public liability insurance policy on the basis that the company has no net liability as a result of the claim. The finance director has not recognized any amounts in the financial statements and has not made any disclosures in relation to the matter. So the first thing that I need to do, ladies and gentlemen, is to come and assess the materiality. Assess the materiality. So materiality of 1.2, because it's a liability, please take this materiality, take the materiality by comparing it to the total assets. So 1.2 million divided by 22,000, 22 million, I mean. So remember the claim is 1.2 million. The claim is 1.2 million. So the claim here is 1.2 million. The claim is 1.2 million divided by 22 million times 100. So I'm testing for materiality. I'm testing for materiality. So I'm testing for materiality. So the materiality here will be, we have the 1.2, we have the 1.2 million divided by 22 million times 100. So, ladies and gentlemen, this gives me 5.45%. 5.45% is very material to the, in relation to the total assets. If this figure is left out of our statement of financial position, ladies and gentlemen, then automatically things will not be okay. There won't be what we call faithful representation of our figures, of our financial statements. They won't be faithfully representing what is on the ground. So we must call for this adjustment, right? You know, one thing that you're supposed to appreciate is that this finance director thinks that because the insurance company has taken up the responsibility of paying this gentleman who was injured in our site, that those figures should not pass in our statement. No, they have to pass in our statement of financial position. Remember, anytime the insurance can bolt out. So in this case here, what we're supposed to do is to recognize. So we need, in this case here, a liability. We must, in this case here, credit our liability. We must increase our liabilities with 1.2 million, I mean, the amount there which was awarded to this gentleman by the courts. And then, of course, we must come and debit our assets. Our assets, why are we debiting this asset? Because we expect an income. We expect an income from an insurance company. So we must debit, in this case here, our asset, which is coming from insurance of the same amount. That's how we do it in the financial statements. So this figure is quite wrong. It's quite a material error. If they don't change it, then I'll go to my opinion and say that the financial statements of this company portray a true and a fair view, except for who? Except for this insurance liability, which in this case has not been factored in. So please read the answer here. Please read the answer here. What are we told in this answer? Well, they've told us this answer is this. For legal claim, the claim is material to the statement of financial position. I know you can remember this 5.5%. We got 5.45, 1 mark. Provision should be recognized as per IAS 37 as unpaid. There must be a provision. Probable liability at reporting date. Asset should also be recognized as payment by insurance company is virtually certain. So you should recognize that asset. So the asset and liability should be shown separately on the statement of financial position and not offset, never offset. There is no net impact on the P&L. P&L, of course, will not be affected here. Full details of both provision and contingent assets should be disclosed in the notes to the financial statements. IAS 37 is quite big on disclosures. Remember, these are things which are contingent. So there are provisions and contingent assets. It's contingent, it's conditional. You may not even receive this money from insurance companies. Insurance companies are not very nice, most of them. Impact on audit opinion. If client makes no adjustment, the statement of financial position is materially misstated, and the audit opinion should be qualified on this basis with an except for opinion. And then we have another one, which happens to be talking about asset impairment. I love asset impairments. It's found in IAS 36. I can see an amount of 85,000 here, which is an error, uncorrected statement. So what have they told us about this asset impairment? During the year, significant new competitor entered the market place at one of Clark Company's 7 sites. As a result, the site has experienced a decline in market share and revenue. The company has therefore conducted an impairment test on the site assets. The company's working papers for the impairment test have been audited, and the following figures have been agreed by the audit team. So carrying amount on statement of financial position, the carrying amount is 3.6. Value in use is 2.9. The fair value is 3.9, and then they've given us cost to sell. So the first thing that I'll do here is to calculate a very important metric, which is called the fair value less cost to sell. 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 So we have what we call fair value. So fair value less cost to do what? To sell. Fair value less cost to sell. So fair value, they've given us a figure of what here? They've given us a nice figure. Fair value, fair value, fair value. They've given us a figure of what here? 3.9. So this is 3,900. If I put my figures in thousands, that is 3,900. So we have 3,900. We have 3,900 minus open brackets, 3,900 minus open brackets, minus open brackets. So we have legal cost. Of course, these are good costs. You can't sell without these legal costs. So 126 transaction taxes, you have to include them as cost to sell. Of course, for you to be able to sell, you must remove these assets. So cost of removing assets, very important, 5. But cost of reorganizing the business following this is not cost of selling this asset really. So it is these three, 126 plus 124 plus 85. So 126 plus 174 plus, in this case here, 100 plus 85, I mean, like that. So please come and give us fair value, less cost to do what here, fair value, less cost to sell. Don't include this business reorganization really. That's not our business. Once the thing has been sold, we don't know how, you don't want to know how you'll be reorganizing your business. So then we have fair value, less cost to sell. So fair value, less cost to sell. What do we have here? We have 3,900 minus 174. So we have here 35.15. So in this case here, this is the fair value, less cost to sell. So if I sell this asset, this is what basically I will realize. So if I sell the asset, I will realize 13.15. What if I decide to use, this asset, if I decide to use the asset, if I decide to remain with it and use this asset and use the asset, this is what I'm going to earn. You can see value in use is 2,900 in thousands, is 2,900 in thousands, is 2,900. So the value in use is 2,900. So in this case here, between the two, which one is the better decision? The better decision here is to sell. And earn how much? 35.15 and earn 35.15. So remember, the better decisions value is what we call the recoverable value. So the recoverable value is 35.15, right? Now, this recoverable value, we shall now go and compare it with the carrying amount in the books of accounts. What is the net book value? In the books of accounts, how much are we carrying this asset at? In the books of accounts, how much are we carrying this asset at? In the books of accounts, the carrying value in the books of accounts, the carrying value they have told us here, carrying amount is 3,600 in thousands, remember, 3,600 in thousands. So we have here 3,600. So the net book value is 3,600. And then now we have the recoverable, what we are able to recover ourselves. So recoverable amount is 35.15. And you are told that when the recoverable is less than the net book value, you must reduce the value of your asset. Don't over-expect, right? You are carrying the asset at a higher value than what you can receive from it, what you can recover from it. So here the recoverable value is less than what here the net book value. Therefore, there is an impairment. So there is an impairment which has to be recognized in accordance to IS 36. So the impairment here will be 3,600 minus 35.15. So 3,600 minus 35.15. So we have here 3,600 minus 35.15, which will give me 85. So the impairment loss is 85. Impairment loss is 85. So the impairment loss that should be recognized is 85. So what has this finance director done? So we are told here, on the basis of the results of these figures, the client has calculated the recoverable amount of the assets as 3.6 million. Remember, ours was 35.15. And they concluded that the site has not suffered any impairment. You see, that's wrong. For us, we have seen from our calculation that there is an impairment. So no adjustments have therefore been made to the financial statements. So in this case, ladies and gentlemen, there is a misstatement. There is an error of 85,000. We got here this error. So before I start pushing these people to make changes, because I'm the auditor, before I start pushing these people to make the changes, I need to see whether this figure of 85,000 is material. Is it material? Is it material to the assets? If you look at the 85,000 here to the assets, 85,000 to the assets, let's check. 85,000 to the assets. So we have 85,000 to the assets. So it's 85,000 over 22 million. 2 billion. What do we have there, somebody? Times 100. So it will be 85. It will be 85 divided by 22 times 100. It gives me 0.38, 0.4% basically, which is less than 1%, immaterial. And because this impairment loss will also feature in the income statement, please also check it out for materiality in the context of the group, in the context of the profit. So the 85,000 in the context of the profit before tax, we're given profit before tax, it was given somewhere, profit before tax was 2.3. So if you take that 85 divided by 2.3, what do we have there? 85 divided by 2.3 million. So we have here 85,000 divided by 2.3 million, divided by 2.3 million. What do we have there? So we have here 85 divided by 2,300 times 100, giving me 3.7. 3.7. Remember, it is 85,000. 85,000. Profit before tax is 2.3. Yeah. So, ladies and gentlemen, we are getting here a figure of what here? A figure of 3.7. Now listen and listen to me very well. In the context of the asset, this thing is what here is immaterial. So please look at, so should we push these people here to change? Look at the answer here. So you're told here, impairment of 85,000 is not material in isolation to either statement of financial position or profit or loss. New competitor is significant change in site's market and therefore impairment indicator. Site is a cash generating unit and therefore appropriate to conduct impairment tests at this level. Recoverable amount is a higher of value in use and fair value less selling cost. So fair value less cost of disposal is 35.15. We got this figure. And therefore asset is impaired by 85,000. Client appears to have incorrectly excluded cost of removing assets from calculation, but correctly excluded the cost of business impact on audit opinion. Assets and profits are both immaterially overstated. Hence, if no adjustment made, there will be no impact on the audit opinion in relation to this issue. Now, ladies and gentlemen, we move on to the next item. So the item that I would want us to look at here basically is this. Part B, your client portfolio as an audit manager at Coram & Company also includes Turner Company, which is a listed financial institution offering loans and credit facilities to both commercial and retail customers. You have received an email from your audit supervisor who is currently supervising interim testing on systems and controls in relation to the audit. So one of your team members who is your audit supervisor. Yeah, the email gives the following details for your consideration. One of the audit team members, Janet Stott, has provisionally agreed to take out a loan with Turner. The company we are auditing will be giving one of our audit staff a loan to finance the purchase of a domestic residence. The loan will be secured on the property, great, and the client's business manager has promised Janet that he will ensure that she gets the very best deal which the bank can offer. The payroll manager at Turner Company has asked the audit supervisor if it would be possible for Coram and the company to provide a member of staff on secondment to work in the payroll department. The payroll manager has struggled to recruit a new supervisor for the organization's main payroll system and wants to assign a qualified member of the audit staff for an initial period of 6 months. Required, comment on the ethical and professional issues raised in respect of the audit of Turner Company and recommend any actions to be taken by the audit firm. Now, ladies and gentlemen, listen to me very well. I'll just speak briefly before I read the answer. The first issue at hand here is that my staff member, remember I'm the audit manager here. I'm the audit engagement partner here. My staff member has asked for a loan from this particular company that you're going to audit. And unfortunately, this company that you're going to audit is a bank, right? So of course, should they give this person a loan, there are very high chances that they shall be able to do what to compromise our independence, because that person will be told, hey, if you don't give us this audit opinion, then you're going to ask for what? You're going to ask for our money back. But now remember one thing, that these guys are not doing this member of mine a favor. They're in the process, they're in the business of offering loans to people. If my member is not able to get a loan from them, she can easily go and get this loan from another bank. After all, they are not giving her any preference. They're not doing her any favor, like reducing the rate. That's why the lady told my audit team member that she'll try to get the best deal that the bank can offer, right? The bank can offer. So in this case, ladies and gentlemen, this is a business that is in the, or rather it's a company which is in the business of offering what year money for loans. So if my member takes a loan under ordinary course of business, terms and conditions are exactly similar to what outsiders are being given, right? And most importantly is that whatever money shall be advanced is being secured by the collateral that the house is buying, like that. So there is nothing wrong, but remember, we have really to disclose that concept of that we could be compromised to the management and explain, of course, you're not against because of this and this, but this is there. Just get to realize that this is a member of my audit team. So as you give her the loan, be cognizant of that fact. And then now we have this other second. The second requirement is where we as auditors are being asked to do what here? We are being asked to employ, help in this case here the bank get a member of staff, and perhaps in this case the member of staff to come from my auditing team. There I can see a problem with what here independence, right? Because you know this person will go there will be giving us a lot of information, right? And after all, if after some months we're going to recall the lady to come back to the audit team, what will happen? We'll be getting a situation where we shall be reviewing our own what here, our own values, right? So there is a self-review threat. So it's just quite a small kind of interpretation, and then we read the answer. So, ladies and gentlemen, here we are. We are told here something very interesting. We are told here something very interesting. We are told here something very interesting. Loan to a member of the audit team issues potential self-interest threat to auditors' independence. Key issue is where the very best deal which the bank can offer is made under normal lending procedures, terms and conditions. If not, self-interest threat created would be so significant that no safeguards could reduce it to acceptable level, and Janet should be told not to take the loan. That means if she, for example, is being given the loan at a very low interest rate simply because she's an auditor there. If it's made under bank's normal lending conditions, terms and conditions, the loan does not create a threat to auditors' independence, and Janet may accept the loan. Actions: discuss terms and conditions of the loan with Janet and the business manager. Obtain draft loan documents and review details in order to establish whether under normal lending procedures, terms and conditions. Inform audit engagement partner who is responsible for ethical compliance. Advise Janet on outcome of review and whether she can accept the loan, and advise business manager of decision explaining rationale, ethical issues. Temporary staff assignment issues potential self-review threat to auditor independence. Must not assume management responsibilities or provide non-assurance services prohibited by the code. Right? Cannot provide accounting and bookkeeping services, including payroll, to audit client, which is a public interest. If it's public interest entity, of course, you can't do that kind of an excess of seconding your staff to the client. Exception if service relates to matters which are collectively immaterial to financial statements. Actions: discuss details of proposed role of seconded member of staff with the payroll manager, other key client contacts in order to establish significant materiality of role to the financial statements. Advise client of outcome of these inquiries decisions. Seems like that we'll have to decline assignment of staff members payroll supervisor as role appears to be material significant the financial statements. Listed public interest company supervisor management role requiring qualified member of staff on main payroll system. So at least you have some high level understanding of this. Otherwise, thank you and thank you very much. Bye.